Hi everyone, I'm John, one half of the Corporate Breakout couple. Recently, there are a few financial hot topics surrounding Singapore, the country which I'm from, and Malaysia, the country that I'm currently residing in. Let's start with Singapore. A few weeks ago, the Singapore government announced its budget 2024, and one of the key changes affected people who were planning for retirement, especially those that were aged 55 and above, and this component called the CPF, Special Account Shielding, was now closed. This gap was closed. Now, I'm not going to go into the mechanics of these CPF changes, you can read about it online, but the gist of it is the special account is now closed to those 55 and above that wants to enjoy an interest rate of 4.08%, which you can freely withdraw, but now you are forced to move to either a retirement account at 4% interest but you are unable to withdraw, or move it down to a lower interest bearing account, which is ordinary account at 2.5% per annum. Understandably, this drew a lot of backlash, especially from Singaporeans planning for their retirement who no longer can use a 4% per annum kind of calculation in order to draw money for their retirement needs. Moving over to Malaysia's side, recently the Malaysian government, the KWSP, announced the EPF dividend payout will be at 5.5% for conventional savings, and that is an increased year-on-year rate that has been very high in the last 5 years. That's good news, right, for working employees who have been steadily contributing to the EPF. Maybe at this juncture, Singaporeans and Malaysians, you might be asking me, John, what has these two topics with these two countries got to do with each other? Oh, they are absolutely related. Remember, both are government social security and retirement funds for the nation. Moreover, each country requires you to contribute a certain percentage of your working income, the EPF for Malaysians and the CPF for Singaporeans, until the day you stop working. A few questions I'd like to raise is, who controls the percentage payout for each of the accounts? And number two, who decides whether the money gets locked in and when it gets released to the people who actually owns the money? Well, before I continue, let me just qualify, I have nothing against each of the government and their own social security systems and the relevant payouts. They are there for a reason, for the nation's purpose. Also, whatever I'm sharing is solely my own opinion and for educational purposes only. The key reason for bringing up all these topics, whether it's in Singapore or in Malaysia, is to ask you and bring you to the gist of today's video, which is, are you ultimately in control over your finances? Or are you leaving your finances in the hands of other people? I'm not just referring to putting your money into government funds like EPF or CPF. It could be any other third party. It could be through your financial planner to invest in mutual funds. It could be a fund house or even an asset management company. The common denominator here is you're leaving your finances and your money in the hands of a third party. I'm not here to point out to you whether that's right or that's wrong. I'd like you to consider and ponder over these 4 points that I'd like you to think about when you leave your money in the hands of others. The first consideration point is you don't get the opportunity to learn. For example, you put your money in the hands of the fund house or the government, their investment arm will go into different vehicles, whether it's treasury bonds or whatever stocks, which you will not understand the whole process behind because you are not in the thick of the action. The danger here is when things go wrong, when the funds doesn't return the kind of returns that you expect, you then don't know what to do because now your money is trapped and you don't know how to pivot. Which brings me to point number 2. You can't pivot easily and you can't move your funds fast if your money is in the hands of somebody else, can you? Because you are not in charge. They are. Which brings me to point number 3. Who is holding the responsibility of the money and the funds? I believe the majority of people, once they hand over the funds to somebody else, they take a really passive approach, not wanting to actively get their nose into the news, knowing what's updated, and having perhaps certain unrealistic expectations for their funds. Therefore, that responsibility of the funds is actually handed to somebody else. Which brings me to point number 4. When you put your money in the hands of other people, let me ask you, who is holding the risk for these funds? I'm not sure whether you are aware of this or not, but it's you. You are holding maximum risk. When the dollar is lost, whether it's to a stock market, to a mutual fund, whatever the instrument is, you are losing the money and not the one that's handling for you. For example, your financial planner or the management firm, they are still drawing their management fees and their commission. So the maximum risk is on you to lose every single dollar. By putting your money in the hands of others, you actually deny yourself the opportunities to learn how to build a better relationship with money, how to manage money, how to grow money, and in case you didn't notice, a lot of life decisions. actually revolves around money, isn't it? Like your job, like how much money to go for that trip, like for example, freeing up time. My point is, I believe many people have subconsciously allowed money to come in and take control, to play such a pivotal role in their decision-making process, such that they forgot money is merely a tool here to serve you and help you in your goals and aspirations. Now back to the two financial topics that I opened up with, the EPF and the CPF. Now for Malaysians, for the EPF return of 5.5% is great, right, for 2023. However, I don't mean to sound like an old broken record, but you do know that with ringgit, right, that's depreciating against many other currencies, that bites back at you in the form of inflation when you are consuming or purchasing imported goods like Starbucks, McDonald's, right? Or when you use your ringgit overseas when you travel, and that's when you really need to exchange a lot of ringgit for a stronger currency. For Singaporeans, it's a different issue. As a Singaporean myself, I feel that Singaporeans are too reliant on the government and the financial planners for their future finances and also retirement planning. Because Singaporeans leave their money in the hands of others too much, you get comfortable. When you get comfortable, lifestyle inflation kicks in because you have some extra money, you don't know what to do with it, you cannot see anything short-term to do with it, and therefore you spend it, and that is a danger of getting into the comfort zone. In order not to have an over-reliance on other people to manage your money, here are 3 ideas that can help you and support you on your future planning. These are 3 basic ideas that I'm going to share with you on a high-level basis. If you want me to go more in-depth and all that, of course I can create for you in future videos. Put in the comments below. The first idea is to build a second property portfolio. Now, that seems like a very basic idea and it's kind of a no-brainer. But what I'm understanding is many people think that they need to first save the money, let's say the down payment for a second property that could perhaps be in hundreds of thousands, before they start to learn about investing in a property. And that order for me is incorrect. It really doesn't cost you much or hurt you to spend some time to learn about the property market, to learn how everything ties together before you are finally ready to buy your second property. The second basic idea is to invest in ETFs or high market cap blue chip stocks. Again, it doesn't hurt you to learn about it first and start with a very small account, say a 4-figure account, before you start to scale as you get better. The third idea is to start a side hustle that can increase in productivity value over the long term. What do I mean by productivity value? In short, it means dollar per hour. Let's say you have a skill, let's say experience in business development. You can be perhaps a business consultant and you start consulting small companies first, and perhaps you charge $300 per hour, for example. Over time, when you build out your portfolio of customers and you get more testimonies, you can perhaps charge $500 or $1,000 per hour even for the long term. So you need to think long term and see how that dollar per hour can get you more and more. Other side hustle considerations that work by dollar per hour, note that this is an active income, not like the other 2 I mentioned, those are passive. You could be, for example, an online tutor, right? As you get more of your students who do well in their studies and you hold this side hustle for the long term, you can charge more dollar per hour. Another example, copywriting, right? Copywriting is also something that you can do remotely as well. In conclusion, I'd like you to take away 2 points. The first one is take control over your finances and try not to leave it in the hands of others, at least majority of it anyway, because that will then give you the peace of mind that you are within control and also give you the different experiences that you need to have in your financial journey. And the second is to always learn and build new income skills, and that will definitely serve you for the long run and is actually your safety net, especially when you retire and yet you still have skills to fall back on. I hope this video has been an eye-opener and got you thinking. If you enjoyed this video, do hit the like button, subscribe and join our YouTube family so that we can create more videos like that for you. Otherwise, see you in the next video.
Do you know we have an awesome community of like-minded people who want to win in life called the Breakout community? Click on the link below to find out more and join. See you there.